Today, I'd like to talk about a very interesting loophole in the tax code for deferring capital gains on vacation homes, real estate properties, properties that are not your primary residence. And this is the 1031 exchange. Hello, this is Jon Queen with the Queen team at Coldwell Banker Real Estate in South Denver. Your real estate experts for everything relocation, property selection, and investment properties. We get a lot of calls every day about people with a wide variety of real estate questions, so please don't hesitate to call us, or you can always email us at queenteam@coloradohomes.com, and we're happy to talk about anything that you like. Feel free to like and subscribe to our channel. Click that notification button if you're interested in real estate investment topics, because we will be uploading them on a regular basis each week, so you can stay up to date. And please, if you have any questions, feel free to leave them in the comments below, and Violetta and I are happy to address them and walk you through it. The 1031 exchange is section 1031 of the Internal Revenue Code, which says if you have property and you exchange it for similar property within a fixed number of days, you can avoid paying capital gains tax. And this is very important because capital gains tax can be between 15 and 20% depending on your tax filing status. So, in other words, it's a way to accumulate and grow a portfolio of either vacation or investment properties without paying 15 to 20% every time that you want to grow it more. My favorite use of the 1031 exchange is when you have a vacation home, or potentially you have a home that you are moving into a larger home, but you don't want to sell that first home. You want to become a landlord. You can sell that property, use a 1031 exchange service provider, and then split that property from maybe one $600,000 home into three $300,000 homes, with mortgage picking up the balance. And you can collect the delta on those rents. And so all of a sudden you've gone from having one property with one rent to now having a series of properties with a series of rents, and you've not paid tax to increase that portfolio. Your tenants are paying down the properties for you, and you are creating wealth for your family and for your future. And of course, if you contact me at queenteam@coloradohomes.com, I can walk you through the whole process. And also feel free to talk to your attorney or your tax accountant about this, because they are the experts in this area. And if we were to proceed together in a transaction, it would be in your best interest to take tax and legal advice. So what are the 1031 rules if you want to take advantage of the 1031 exchange and grow your real estate wealth without paying capital gains tax? Well, it's actually pretty simple. The first is you have to invest in property that is of the same or greater value than the property that you're exchanging, which means if you're selling a home, for instance, for $500,000, you have to exchange that into properties that are worth at least $500,000 combined. It can be one property, it can be more than one property, but it has to be at least $500,000 from whatever the net proceeds was from your original sale. Rule number 2, you have to acquire equal or greater financing to the financing that was on the original property. So that means that if you had a $200,000 mortgage on the property that you are selling, the combination of properties that you're exchanging into must have at least in the aggregate $200,000 worth of mortgage between them in order to satisfy the equal or greater financing prong of the 1031 exchange. So who can take advantage of 1031 exchanges? Well, it can be pretty much any person or legal person. So that means you can be a family, you can be an individual, you can be a corporation, you can be a partnership, you can be a trust, you can be pretty much anything that qualifies as a legal person under U.S. law. So that means that the 1031 exchange works equally well for the family looking to grow their real estate wealth and become landlords without paying capital gains tax on their growth of their portfolio, or the estate planner who already has their property perhaps moved into trust, but they're also looking to grow that property and they don't want to pay capital gains tax. Both situations, you can take advantage of the 1031 exchange. And in fact, corporations do this all the time in the commercial real estate context. I mean, it's very rare that someone a corporation will sell a piece of property and then realize capital gains on that sale without using a 1031 exchange to transition into new property. So what's the timeline to the 1031 exchange? The timeline is very important if you want to take advantage of this tax loophole. And the timeline is as follows. So before you contemplate undertaking this transaction and doing this exchange, you already want to have your 1031 service provider identified. You want to have them lined up and ready to go, because as soon as you sell that initial property or begin this transaction, you're on the clock. And the clock is as follows. You have 45 days from the sale of your initial property to identify your replacement property. And that means you have to come up with a list and submit that electronically or in person to your 1031 exchange service provider. Then, once you've crossed that threshold in time, you have a total of 180 days, including that first 45 days, to complete all of your 1031 exchange transactions. So what does this mean? This means that once you sell your, for instance, your vacation home that you're not using anymore in Maui, and you're exchanging that into 3 really highly rentable single bedroom apartments downtown Denver, you have 45 days to come up with those initial properties that you're going to trade into. And then you have 180 days to complete the transaction, including that first 45 days. So you're on a strict timeline. You want to make sure that your 1031 service provider is there, lined up, ready to go, so you can just do what you need to do without worrying about being under pressure of time. So a common question that comes up is, how do you identify the types of property that you can use to exchange the property that you're getting rid of under this 1031 exchange? Well, there are 3 general rules. The most commonly used rule is the 3 property rule. And this means you can exchange your property for any 3 properties of any value. So that means if you sell your 1 property for $500,000 and you move it into 3 properties that you pay $500,000 down on, maybe the balance of mortgage, you satisfy that rule and you've done a 1031 exchange and you've avoided capital gains tax on your transaction while growing your wealth threefold. The second most commonly used rule, which is an alternative to the 3 property rule, is the 200% rule. And that is when you want to acquire more than 3 properties. It can be any number of properties. And 1031 exchange rule says that you can do that so long as those properties don't exceed more than 200% of the original value of the property that you are exchanging out. So what does this mean? This means if you're selling that $500,000 Maui vacation home, moving it into highly rentable real estate downtown Denver, that you cannot exchange it for more than $1 million worth of real estate in downtown Denver. But having said that, it can be 4 properties, each one $250,000. And the third rule, which is also an option, that if you don't want to use the 3 property rule or the 200% rule, is the 95% rule. And this is when you want to exchange that $500,000 Maui vacation home you don't use very much anymore into the very highly rentable downtown Denver real estate. You do not want to be limited to 3 properties, and you do not want to be constrained to 200% of that Maui real estate property. The 95% rule means you can exchange that $500,000 property in Maui for any number more than 3 of properties in the downtown Denver area, and it could have any value all in. So you can exchange, for instance, for your $500,000 properties for 5, for instance, $300,000 properties with $100,000 paid down, $200,000 mortgage on each of them. So you've now transferred your $500,000 property in Maui to $1.5 million in property downtown Denver. The only rule there is you have to submit in your original property list to your 1031 exchange service provider your list of properties within 45 days, and you have to close on 95% of those properties, at least 95%. So if you submit, for instance, 5 properties, it means you have to close on all 5 of those properties. You have to close on virtually 100%. If you submitted 100 properties, you would have to close on 95% of those 100 properties. So that is the 95% rule. It's not used as commonly for the usual taxpayer, because usually we can get away with the 3 property rule or the 200% rule, but it is there available if you need it. So what are the rules of the 1031 exchange property identification in terms of the actual steps? Well, the first is, obviously, you have to identify all of your property within 45 days. And you have to identify it in writing and submit that written list that unambiguously, that's a legal description or extremely detailed description, to your 1031 exchange provider within 45 days. You've submitted an unambiguous, clear list of the properties that you're going to exchange into, given it to them either electronically or in person within 45 days of triggering this whole process. Your list must be signed and dated by all taxpayers. This is also important. You don't want to miss that step and just have one person sign. If it's a husband and wife team, you want both. And if you've done all that, if you submitted your list within 45 days, it's unambiguous, it's in writing and signed by all the taxpayers, and you've send it to your 1031 exchange service provider, you're pretty much golden. I mean, you've done this, and now it just comes down to completing the transactions and switching your one property into more properties. So what are the types of 1031 exchanges? Well, there are 3 types, and we're going to go through them all right now in order of their popularity. The first type is the forward exchange. That is the process that I've pretty much been using in my examples, where you sell one property, exchange it into new properties within 180 days, and as long as you follow all the procedures that we've described so far, you've avoided capital gains tax under Section 1031 of the Internal Revenue Code. The second most popular method is the reverse exchange. This is a situation where you have identified and closed on your replacement property first, and then you sell your original property within 180 days of acquiring the replacement property. So it's the 1031 exchange, but it is done backwards. And the third type of 1031 exchange, which is used more in the commercial setting when you're buying perhaps a strip mall or some property that needs to be improved upon, is called the improvement exchange. And this is a situation where you use part of the proceeds from your original sale to do upgrades and improvements to the new property. So it's not the case that if you sell your Maui vacation home and say you want to buy a strip mall, and that strip mall needs about $100,000 worth of improvements, you don't need to put the $500,000 into your down payment on the strip mall. You can put in $400,000 in the down payment on your strip mall, and then use the $100,000 improvements to also qualify for the 1031 exchange. But to do that, again, you need to use what's called the 1031 exchange accommodator. Your 1031 exchange service provider or attorney or tax professional can advise you how best to do that. But you do have that option if you're going to be buying property that requires some upgrades, and you would like to use that upgrade money from the proceeds of the sale of your prior property. 1031 exchange allows you to wrap it all in and treat it, for the purpose of avoiding capital gains, as one big exchange. So folks, that is a 1031 exchange. Why it's useful to you? You can grow your property portfolio by deferring capital gains. If your stockbroker could tell you, if you invest in this stock, pay some money down today, and then you're going to be able to split that stock out in the future for infinity, as long as this tax code allows us to, and never pay capital gains tax and just keep growing your portfolio, well, that would be the only stock that I'd be interested in as an investor. That would probably be the only stock I'd be interested in recommending on a mass basis if I was a registered investment advisor. Well, this is what you can do with real property right now under the Internal Revenue Code. You can take some property that you are maybe only getting one rent on or no rent on, split it into multiple properties. They can be a very smart growth strategy, create generational wealth for your family, and we're happy to talk to you about that or recommend you to the tax and legal professionals who can better answer specific questions if you need those recommendations and don't have ones of your own. But in any case, please feel free to contact us. This is something that we're very passionate about and love to help people get into and do, create that generational wealth for their families, grow their portfolios. And you can contact us at queenteam@coloradohomes.com. I'm Jon Queen. It's been a pleasure talking to you, and I look forward to our next discussion related to investing in real estate.